Hey guys, it's Serge here. I've been getting a lot of questions over the past few months actually on why the market has been so choppy this year. And it's been a very difficult market for just about all traders unless you are intraday trading or doing say big spread option spreads, which I think would be an appropriate environment, has been an appropriate strategy for this kind of a market year to date. But the question, remains: why is it so difficult of a market? Why is it so choppy? Why are stocks not really going anywhere, at least from a broader perspective? And quite frankly, the story remains the same. The stock market in the U.S. and in Europe, and to a large extent in Asia as well, is very much focused around global central banks. So when we're talking about specifically U.S., it's mostly the Fed, and the Fed has sort of wiggled itself into a spot where it feels pretty cozy in the sense that it continues to reiterate this data dependency, which it probably believes in, um, and investors are seeing that data hasn't really gotten good enough to support an imminent raise in rates, nor bad enough that they would completely alter their strategy. So there's no real reason for investors here to chase stocks higher meaningfully or to jump ship and sort of hide under a rock. Neither environment, neither scenario has played out yet, and that's why the market's been choppy. So if you look at yields in a 10-year note, which is a sort of an interesting benchmark to look at, on the low end about 1.7 or so percent, on a high end about 2 point, let's call it 3%. So you got about a 60 basis points range in yield terms in which interest rates have basically moved around on the 10-year part of the curve, and that's a pretty sizable move. But yet everyone is kind of still focused on what the Fed will do in that. So it shows quite a bit of complacency and confusion at the same time, which is exactly what makes this so difficult and so hard to understand. But more importantly, quickly getting back to equities, and it's a point that I've brought up several times already this year, even in these videos. And that's really has to do with the fact that I do think this consolidation phase, for lack of a better term, that we're having here with an upward bias, ultimately, if we do get a shakeout to end it, will have been a constructive move. And I think the shakeout will probably come on the back of either some geopolitical risk, but probably again more central bank related, on an imminent threat of the Fed raising rates, even if it's just for 25 basis points. It's the thought of it that'll spook investors. And after they've gotten used to it, after the market gets flushed out, that'll have been a pretty constructive a price action to then again buy stocks. So again, to summarize all I just said, I think the reason the U.S. equities were very choppy this year, and European stocks as well, by the way, except for the one big rally they had in February-March period, is again it's very much central bank oriented. In the U.S., the Fed has been playing the game pretty well for considering the track record they have, and until things change, it'll probably remain status quo here for at least another bit until markets get somewhat more volatile. So I hope this makes sense, guys. Please like this video. If you got any questions, you can follow me on Twitter. My Twitter handle is StudyTrader, and go over to the StudyTrader.com and see what we're doing over there. Take care, and I'll see you in the next video.